Welcome to the Armchair Trader podcast. Today we're talking about smaller companies and the AiM market, and we have on the program today Ivan Sedgwick, who is the investment director at LGB Company, which is a leading city capital markets and investment boutique. Welcome to the show, Ivan.
Yeah, LGB tries to help small companies grow. We do that in a couple of ways. We work with high net worth individuals, family offices and similar, providing funding for small companies, largely on AiM, and quite often where there's an EIS element to a fundraise. My job as investment director is to kick the tires on things we get shown by the brokers and try and dig out some things for ourselves. We do a bit of investing in unquoted companies, not a great deal because the due diligence requirements are very high and the maintenance can be quite tricky. The other part of our business, and we're unusual in this space, is that we also provide debt funding to small companies, including some AiM companies, but also unlisted companies, and try and help in that space where the banks are not present, but where the alternative funders can be very expensive. So we have what are called MTN, medium-term note programs, which is technique derived from large company funding, which we use for smaller companies.
And today we're going to be talking about smaller companies. There's certainly something we do a lot of work on here on the Armchair Trader. It's an area of the market that we've still seen getting a lot of interest from investors, including during the depths of the pandemic, where we saw some very big moves from some AiM listed stocks. What's been your impression of the performance of the AiM market during the pandemic and also now as we're emerging from it?
I think during the pandemic it was extremely encouraging. I mean, if you take a longer term view, one of the concerns about AiM has been the decreasing number of institutions involved in that market, and that probably reached a low point around the Woodford problems. But institutions do seem to be coming back. But at the same time, during the pandemic, we also saw a real resurgence in retail investor interest. And we saw a lot of confidence when companies came to the market and said, right, we need some help to get through this. And the investors said, yeah, we still like the long-term story. And yeah, we think we ought to give you that money. So a lot of money was raised in 2020, really essentially to help companies get through. And then since then, where the stories are intact, to help them grow. So the market has been working properly as a sort of place for allocating capital, which is good. There are still too few institutions involved, but these things take a while to change.
And in terms of IPOs, we've obviously seen quite a few coming onto the market. How do you see the market for IPOs at the moment, both or particularly for companies that might be looking to go public in the near future, and also sort of looking ahead into 2022 as well?
The market seems to be quite good. I think we have to put this in perspective. People agonise about companies going to NASDAQ. And the NASDAQ IPO market is just so much larger than say, to AiM. I mean, I think first half of this year, something like over $100 billion was raised on NASDAQ for IPOs, not for secondaries, just for IPOs. And that compares with about $1 billion for the first 8 months for AiM. So it's a different scale. The market does seem to be good. It's very much supported by the venture capital trusts. And it's interesting, again, if you make the comparisons, the US doesn't require that sort of tax break to have a thriving market, and we do seem to. And the problem there is that the VCTs are great for getting deals off the ground, but almost by definition they're not there in the secondary market because there's no tax break for them. The scale of the deals, I think the average size of an AiM deal this year was only about, well, the average raise was only about 20 million sterling, which is pretty small, which means the amount of fees aren't that great, which means they tend to be done by a single broker, which means the outreach isn't that great. What we are seeing, which is good, and I think is good for the health of the market, is The big investment platforms are sometimes getting involved, but it tends to be on fund launches rather than on individual company launches. And you're also seeing a little bit of activity from primary bid, which seems at the moment to have pretty much a monopoly. But I think there are still some defects to the market, and I'm not sure that the Hill review necessarily changes that. The evidence of the last year or so is that there's a lot of retail interest out there, but it's not made terribly easy for retail investors to get involved in IPOs.
You mentioned investment platforms getting involved, and you've mentioned primary bid. Can you give us an example of other investment platforms that are active in the space?
You occasionally see, well, I mean, I can think of, Hargreaves Lansdown, retail brokers like Redmayne, Bentley will occasionally show their investors deals, but it's not taken for granted, and I think a lot of the brokers who are active on AiM are rather suspicious of doing that. They just see this as their fees disappearing out the door rather than seeing it as a way of expanding scope.
You mentioned the Lord Hill review. Can you give us a little bit more sort of background on what that's proposing and how you think that's going to affect the or potentially could affect the smaller companies market in the UK, and also the listing of cash shells? I know you've mentioned Nasdaq and the worries about whether companies will go and list in the US rather than the UK. Can you just give us a quick summary of that and how you think that potentially could put some more momentum into this market?
Yeah, I don't think I can give you a full review of the Lord
No.
Hill report. I think the Hill report is something of what journalists refer to as a reverse ferret on the part of the authorities. In that the FCA, when we were part of the EU, were the absolute zealots in terms of increasing regulation. So it's interesting to see an attempt to roll back parts of it. But I'm not sure it really, again, from our end of the market, I'm not sure it really tackles some of the deficiencies. If you look at the US, the rules for IPOs are essentially the same information has to be made public and available to everybody at the same time. Here we still have this frankly absurd situation where in order to protect the widows and orphans, they're not allowed to see these wicked new issues. But on the first day they're trading in the secondary market, there's nothing stopping them trading in them. I mean, this makes no sense, and I can't see that the Hill report changes that. The SPACs are interesting, and there was actually an FT article today pointing out that we seem to have gone past the peak of the boom in the US and that a lot of money is being pulled back out of them. I've never really seen the argument for them. It's possible for entrepreneurs with a good track record in the UK to use cash shells anyway. I mean, that's how Martin Sorrell got S4 listed. It's how David Monty got his National World listed and took over the old Johnson Press assets. And John Browett is bringing an interesting internet retailing business to market at some stage. And again, that's using a cash shell. So I think, where you do have an entrepreneur with a really strong market, there is a vehicle within the UK to do that already. This whole idea of setting up in sort of South Sea bubble style a company for purposes we know not what with a large pool of money seems to me, frankly, hazardous. Yes, of course, it generates enormous fees for the bankers, so why wouldn't they want to do it? And it generates listing fees for the exchange, so why wouldn't they want to do it? But this is just a money go round, really, surely. The Hill report does propose making this a bit easier, but whether this is really a worthwhile or important part of it, I question.
Do you think there's more that could be done to make the London market more competitive than it is at the moment?
Relative to the European markets, which I spent a lot of my career looking at, I think it's already pretty effective and pretty competitive and reasonably well regulated. The great difference with the US, where regulation is not in all ways easier, in some ways it can be harder, and the SEC is a very onerous regulator. The great difference is the scale of the pools of capital. and the experience of those pools. What's nice is you're seeing some of those funds actually starting to fish in our pool as well, which is good. You're seeing the American so-called crossover funds who invest in the US in unlisted securities and help bring them to market, actually coming to AiM and investing in AiM, because as far as they're concerned, the companies are so small, it's almost like investing in unlisted companies themselves. But the key differentiator is the scale of the investors, and that's the advantage that London has over any of the European markets, and the disadvantage it has to the US.
Speaking of a particular sector in this case, technology stocks have been one of the real hot areas for investors, certainly in the first half of this year. The UK has always touted itself as a little bit of a hub for tech, certainly in the European context. How do you see the tech IPO market? It's an area that a lot of our readers are very interested in, and do you think that they can expect to see a pipeline of more listings coming from that area?
Yes, I think we can, and we are seeing them, but it takes a while to get a tech company, not necessarily a software company, a hard tech company. It takes a while really to get it market ready, and the danger is that companies are brought to the market before they're really ready for it. So yeah, I'm sure we'll see more, but you can't conjure them out of thin air. Despite the lack of big engineering companies in the UK, there's still a lot of specialist engineering expertise, and companies coming to the market out of that. I would say that the UK healthcare sector is probably more fertile, and more interesting. And if you look also at the ones that get away and the ones that haven't, and the Oxford Nanopore IPO is they're talking about that being a what 3.5-4 billion sterling company by the time it comes to the market. On the other hand, another Oxford company, Scientia, which looks as if it could be a $2.5 billion company, is doing its raise on Nasdaq, with Gates Foundation and SoftBank support. So we're keeping some, we're losing others.
When you say healthcare, I mean there's obviously
Sorry, yeah. By healthcare, I mean life science.
and then there's the other area which we see a lot of interest in is obviously the mining and natural resources stocks. There are a lot of these on AIM. Some have a lot of followers in the investor community. I know that, for example, gold mining hasn't done so well this year as the gold price has gone down. What do you see as the sort of prospects for the small cap mining area at the moment, and also further afield, other natural resources stocks like oil and gas?
I wouldn't claim to be an expert at all on the natural resources sector, but a few observations. One is that rare metals mining stocks and refining stocks, I think, will continue to be interesting, and that's an offshoot of the green agenda. Gold, if the bears on inflation like Jonathan Ruffer are right, will have their time in the sun. I think there's going to be a real problem for the oil and gas exploration companies. The backwash of the legal attacks and the whole ESG movement on the big oil, which after all hasn't really responded to the spike up in gas, is I think going to make it harder for companies in the energy sector to raise money. It's possible that we'll end up with a lot of these smaller companies being taken private, because after all, private equity firms don't have the same oversight and don't necessarily have the same constraints, and maybe won't have the same conscience. But I think that's got to be a worry. That's got to be a risk that you take on. It's a political risk for investors, that the operating environment for these companies gets harder and harder. That banks are discouraged from lending to them, and that however glorious the resource base that they're supposed to be exploiting, the money disappears into litigation and higher taxation.
That's a very very gloomy perspective.
Well, just trying to think about how it might play out. I may be completely wrong, but when companies like Royal Dutch Shell are being taken to court successfully in the Netherlands and really having to adjust heavily, it seems unlikely that smaller companies are going to be able to dodge the bullets indefinitely. No, maybe I'm wrong. I say I don't claim any great expertise.
I mean, on the other side of the spectrum, we're seeing a lot of. I mean, I keep saying this, but you can see which areas of the market are doing well in terms of investor buying activity, and certainly the green energy space is still attracting a huge amount of capital, huge amount of interest, both from retail investors and from institutional investors. UK again in a position seen as a bit of a market leader, industry leader. Do you think that's something we'll see a lot more IPOs and activity in over the next 6 to 12 months?
I hope so. I mean, the UK's already got three quite significant fuel cell companies quoted on AiM, and there aren't an enormous number of those dotted around the world, and they're attracting, those companies are attracting, interestingly, investment from corporates, from industrial partners who see the attractions of that technology. We've seen energy storage companies come to the market. There's some interesting developments in battery technology, which I think are at sort of pre-market level at the moment, but alternatives to the lithium batteries, which are emerging. And I've got a meeting tomorrow, so I'm going pre-market with a sodium battery company. So yeah, there's very good technology coming out of the UK universities on the science side, and then there's also the whole sort of infrastructure part of that, the improving the grid, but particularly improving energy storage, regenerative energy systems, and hopefully this will be an area where UK science doesn't end up getting developed overseas and actually gets developed here.
So yeah, a strong domestic investment story, which would be good for
Yeah, yeah.
the
Well, I say it's the exploitation of the technology. I mean, the UK isn't a big enough economy to be the driving market for the end product, but it can be a useful market and a market that you can try things out. But actually, the money is there to bring the science into production.
And the market has been a little bit quiet in July and August. I mean, we saw, it wasn't like last summer 2020, where obviously there was a lot of activity. A lot of people were still working from home. Nobody was going on holiday. Our impression has been in July and August that the small cap market was quite quiet, and as ever with this market, that translates into some companies losing a little bit of value just because the activity is not there and the pricing is not there. What's your impression of the last couple of months in the market, and do you anticipate that picking up now?
Well, both AIM and the FTSE 100 actually hit their highs for the year, which they've sort of got back to in May. So things had already started being a bit feeble, although the 250 continued to move on up. I think it was partly people coming out of their houses and away from their computer screens and actually doing other stuff. There's been a bit of work in the US on this whole concept of investing as displaced gambling when the sports markets were shut. There's probably a bit of psychological truth in that. I think that's one part of it, but also remember there were a few jitters over the summer, and not so much here, but there were jitters in various places, particularly the US, which still has quite a sentiment thing on the on Delta variant, and were we really through the pandemic or not? There were jitters about inflation, and that certainly, again, probably had an effect more on the bigger market than on the smaller market, but certainly the inflation bears have plenty of fuel for their argument now, and just the general pricing increases and logistics problems, which are by no means only a UK problem. Was the record number of ships moored off Long Beach in California, waiting to get a berth. I mean, this is a problem in all sorts of places, although we do seem to have some particularly bad aspects of it. So, the realisation that just because we're emerging from the pandemic, touch wood, doesn't necessarily mean that the economy's full speed ahead. So I think that's certainly a significant part of the slowdown. And I wouldn't have thought we emerge from that holding pattern until we get some signs of the logistics problems easing up, of a bit more visibility on whether the pricing increases are sticking or not. And I think US lumber prices went up fourfold in the spring, and they came down, I think, 40%. It was a suggestion that there. I've talked to some companies involved in the trading semiconductors, buyers of semiconductors, saying, well, we knew it was going to happen. Of course they did. And we prepared ourselves. But we think by the beginning of next year it should have ironed its way out of the system. So I've talked to people in the hospitality industry who say, people are coming back to the UK to work, but it won't really rebalance until after Christmas, because we have such a massive backlog of people trying to organise functions. And I think against that background, I think the market will struggle to go up a lot. I think it's going to be down to interesting individual stories rather than just being able to ride a wave.
And just finally, you mentioned inflation. It's been, certainly in the last couple of weeks, it's been one of the big areas of concern, and we're getting different narratives depending on who you speak to. Central banks obviously trying to talk it down. Do you think that that's a real threat to asset price valuations, or is it more of a blip, and the moment people start raising interest rates, we'll see the wind come out of the inflation sails?
Well, I suppose one of the interesting things is that we've had a whole new paradigm as to how interest rates are set over the last few years. How long does that continue? And if inflation does come back, do the central banks just say, well, tough, we're still not putting rates up because the economy is not strong enough? It does feel as if there is some rebalancing in favour of labour and away from capital, and logically that's got to have an effect on the returns on capital. That's me pretending to be an economist. But if people are going to get paid more, that's going to affect consumers, but it's going to affect shareholders as well. Again, if you're looking in tech or life science companies where there's sort of a big payoff at the end, and where labour costs aren't particularly important to you, maybe that doesn't matter. It does matter in that with companies where the return is a long way in the future, the discount rate that you apply to them is significant to the valuation, and if interest rates go up, then that discount rate changes. But we're a long way from that yet, and interest rates would have to go up a hell of a way before we got back to the sort of levels I remember when I was a nipper.
Well, yes. I mean, hopefully they don't spiral too far out of control.
Indeed, touch wood again.
Well, thank you very much indeed, Ivan, for coming on the podcast and for giving us a little bit more colour around the small caps market. I really appreciate that.
Right, thank you very much, Stuart.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.